The Fed has raised rates. The ECB and the BOJ are still expansive in their policy. What does this mean for the SNB? It's generally considered that the SNB has its hands tied on interest rates until there's a tightening in Frankfurt. Can you think of a scenario where you might have to jump the gun and act first?
Well, we look, of course, at inflation in Switzerland, and we have to maintain price stability. But for the time being, we have no necessity to change our monetary policy. Negative rates are still necessary, and willingness to intervene in foreign exchange markets.
Now, you've said the franc has depreciated 5% in trade-weighted terms since the middle of this year. Still, the franc is highly valued, you say. How do you explain this? What gives?
Well, we had a situation with a significant overvalued Swiss franc. Now the situation is slightly better, but the franc remains highly valued. So if you compare prices between Switzerland and Germany, you see that the Swiss franc is still highly priced. And for that reason, exactly, and also because the interest rate differential is still very small between Switzerland, the Eurozone, and other important currency areas, we have to maintain an expansion in monetary policy with negative rates, but also very important, the willingness, if necessary, to intervene on foreign exchange markets.
Now, you've said that although you've raised your 2018 inflation forecast, you still say that in the longer term, inflation is basically unchanged. However, your conditional inflation forecast does see the headline rate rising to 2.1% in 2020. How do you explain this? And does that mean we should be expecting an interest rate increase in the next few years?
No, not at this point. Well, you have to see, the inflation pressure and the inflation risk is very low in Switzerland at this moment. We have a little bit higher inflation for 2018 because the exchange rate depreciated, but the medium to long-term inflation pressure is unchanged and very, very low. You see the inflation forecast that we published is so-called conditional forecast. We assume unchanged Swiss short-term interest rates, but behind this inflation forecast is an international scenario where monetary policy abroad is adjusted, normalized, and obviously that increases the interest spread between Switzerland and the rest of the world and leads to a certain depreciation in that scenario, which then leads to an increase in the inflation pressure. But this is the technique of this conditional inflation forecast. The actual pressure for inflation remains very, very low.
So you don't think this 2.1% is going to complicate your policy making?
No, not at all. We are convinced that the inflation pressure remains low and that we have a relatively long time before we have to adjust monetary policy.
In the past, you've had a sentence in your statements saying that the expansive monetary policy can't be continued for the full forecast horizon. Is that something that we should be getting used to seeing again?
Well, not at this moment. So we really stick to our monetary policy. We do not say anything regarding the timing, but for the time being, it's clearly that we have to continue with our monetary policy. If you look at the entire data, we see the Swiss franc remains highly valued, interest rate differential is still very low, output gap is not yet closed. All those data speak for maintaining the same level for monetary policy, so we continue with our expansion in monetary policy.